Let's look at one more sales-oriented decision in our G&G landscape setting. Jocelyn, the flower manager, is reviewing the inventory of rose bushes. She is considering whether to harvest some of the existing roses or allow the roses to grow further so that they can be classified as long stem. Essentially, Jocelyn faces a sell as is or process further sales-oriented decision. In terms of available information, if sold as is, the roses would yield the following revenues and costs per dozen. Sales revenue is $12, variable costs are $5, and fixed costs are $3, all on a per unit basis. If allowed to grow further, additional watering and maintenance would incur $4 in additional variable costs per dozen and $2 in fixed costs per dozen. Long stem roses are sold for $18 per dozen. So let's analyze this situation. Now, this is a relatively straightforward example, but I wanted to introduce it to make a couple of key points, and we'll talk about those as we progress through the analysis. So we, as usual, have multiple decision paths that we're considering. In this case, it's two. Sell the roses as they are now, or let them continue to grow, processing them further into the long stem variety. So our decision is to sell as is versus process further. Our revenues under each of those options, if we were to sell as is $12, and if we were to process further, we actually earn $6 per more in sales revenue per dozen, yielding $18 on a per dozen or per unit basis. Our variable costs originally are $5 per dozen. If we process the roses further, we incur an additional $4 of variable costs for watering and maintenance. And so therefore, processing further results in variable costs of $9. The fixed cost on a per unit basis is reported as $3 per unit. And if we were to process the roses further into the long stem variety, our information says that we would incur $2 more in fixed costs per unit, yielding $5 per unit if we were to process the roses further. So selling as is yields a profit number of $12 in revenue minus $5 in variable costs minus $3 in fixed costs, and that amounts to $4 per dozen or per unit. That's the profitability we get by selling the roses as they are now. If we were to process them further, our revenue and our variable costs and our fixed costs all increase. And so the $18 in revenue, subtracting the variable costs of $9 and the fixed cost per unit of $5, yields $4 on a per unit basis. So from a profitability perspective, essentially we're indifferent between selling the roses as they are now or processing them further, because each of the units provides us with $4 in profits regardless of when we sell them. Now, a couple of notes here. One, in many of the previous examples, we ignored fixed costs, especially when they were reported on a per unit basis. But in this case, fixed costs on a per unit basis are relevant to this decision because they change between the different alternatives. There must be additional land that's necessary or being used, and we must incorporate perhaps more manager-supervisor salaries. So whatever the reason, we are actually changing our fixed cost on a per unit basis if we were to engage in the process further option. That means because these costs are different depending on which path we take, it's relevant to this decision, and we're not ignoring the fixed costs. The same argument applies to the variable costs and the revenues, but those things are usually different between decision paths. especially when we're talking about a particular activity of interest. So one point that I'd like to make in this example is that fixed costs in this case are relevant to our decision because they are different depending on which path we go down. The second point that I'd like to make is that we could conduct this analysis via differential analysis or an incremental approach. In essence, we're always going to get at least $12 of revenues, we're always going to have at least $5 of variable costs, and we're always going to have at least $3 of fixed costs, no matter of whether we sell as is or process further. We could have focused our attention purely on what was different or occurring incrementally as the result of processing these roses further. So if I were to take that and pull that out, those incremental amounts, the revenues is 6, the variable cost is 4, and the incremental fixed cost is 2. And I can see that 6 minus 4 minus 2 is very simply $0. That means that incrementally speaking, taking the roses from the current stage to the next one yields $0 impact on profitability. So again, in this example, the fixed costs on a per unit basis are relevant because they are different between the two decision alternatives. And 2, doing analysis via the incremental approach gets you the same decision answer as looking at both approaches separately. So let's have a checkpoint to make sure that we're all on the same page on this sell now or process further decision. So as with every other decision, let's think about the qualitative or non-financial perspective. We've covered the financial perspective, but what other concerns might you have in this setting? Well, one, processing our roses further leads us to the long stem variety, and that might be strategically a better course of action, even though it doesn't do much for our profits. That is, we might develop a reputation for being able to provide a product that takes a long time to produce. On the flip side, because it takes longer to produce, time extends. We go further into the future in order to process and then eventually sell our product. And a lot can happen between now and later. If there is a bad storm or poor weather, perhaps our roses die. And had we sold it as is, we would have profits that we won't have in the future if they're all dead. So essentially, we need to take into account the uncertainty associated with the time between the option to sell now and process further and sell in the future. That's especially relevant in this example where we're talking about the element of time.